Hello everyone, welcome to our deep dive on statement of cash flows. So before we get started, I want to tell you something. This is probably one of the most confusing statements we see. There are a lot of questions in it, and it is very normal that you may not get everything the first time. Just repeat a couple times until you understand. It's not very complicated. I split into four sections. If you understand all four sections, you should cover questions. So let's get started. Okay, why do we need a statement like that? You may reasonably ask, we have an income statement and we know the net income, so why do we need something extra? The main reason is, remember the term cash is king? This very much applies to any business because sometimes as a business owner that maybe you are doing good on paper or from the outsiders, they can see that you are selling your products, but that does not mean you were able to collect the cash. Or there are many variables. Also, if you are working in the accrual accounting, the net income does not reflect your ability to pay bills. So that's why we need it. This statement answers, can the company pay its short-term debts? By looking at it, we can see if the company can pay its short-term debts because they have cash. Their solvency, can they meet their long-term obligations or pay dividends? And predict future cash. If there is enough data, you can see the company's future cash. The statement of cash flow categorizes all activities into three areas: operating, investing, and financing. The operating section tracks cash effects of transactions that create revenues and expenses. This is related to long-term assets, acquiring and disposing of investment and property, plant and equipment. If the company buys or sells property, plant and equipment, the cash coming or going from this activity goes into investing buckets. And the financing is related to debt and equity. Financing is related to obtaining cash from issuing debt and repaying amounts borrowed. Let's start with the operating activities. This is the default category. In questions, they usually give you a balance sheet or income statement. For operating activities, look at income statement items. Those activities include transactions not investing or financing. As I said, those are related to income statements. Now let's look over some important ones. Key inflows. If we receive a cash from customers, if it's sales, it goes to operating activities. Here is something, this could be an exam trap. Okay, so for the interest and dividends received, you may think they are related to financing activities, but for the US GAAP, they are part of the operating activities. They usually like to ask questions from this section, and we will do a couple questions about it. For operating activities, if it's interest or dividends received, we put them in the operating activities. One easy way to remember is the income statement. In the income statement, you usually see the interest received, dividends received, and you can think that it is going to operating activities. Key outflows here. The first one is straightforward. If we pay money for the inventory, that gets from our operating activities bucket. If we pay money to our employees, that's, as I said, income statement item, same operating activities. Interest paid, like interest received, is operating activities. Taxes paid is related to income statements. Dividends paid is related to financing activities. For operating activities, interest and dividends received, yes. Interest paid, yes, but dividends paid is not part of operating activities. Now let's move into investing activities. For investing activities, think of anything the company is doing to build its future. Acquiring and disposing of long-term assets and investments not classified as cash equivalent. If the company buys or sells some property, plant and equipment, this is mostly what you are going to see in the questions, it goes to investing activities. If they are purchasing or selling investments, that also goes to investing activity, anything strategic they are doing. If they are making or collecting loans from others, or if they are acquiring a business, they're all going to investing activities. Here's an exam trap that I want you to pay attention. Okay, if there are some proceeds from the asset sales, it goes here. Purchase or sale property, plant and equipment goes here. But if there are any gains and losses, they are adjusted. They go to operating section in the indirect methods. We're going to go more detailed to that in that section. Now let's start financing activities. Financing activities show how a company funds its operations and provides returns to investors. This section is about where the money is coming from and how it's paid back. What are the examples? Let's say that maybe the company issues a stock or purchases stock that goes to financing activities. The similar way for the debt, if issuing or repayment of debt. If they are paying cash dividends, goes to financing activities. Receiving interest and dividends goes to operating. Payment of interest also goes to operating, but payment of cash dividends goes to financing. They usually give you a balance sheet or balance sheet items. You can look at the equity section to see the values on the questions. And one other example here is the repayment of lease principal also goes to financing activities. Here's an exam trap they like to ask. Instead of purchasing or issuing stock dividends, okay, so this is two. The company declares stock dividends or stock splits. Whenever there is no cash involved, it does not go to cash flow statements because they are non-cash transactions. You may remember I used the term cash and cash equivalent. Let's go over what I mean by that. What does it mean by a CPA exam purposes? To be considered cash equivalent, they need to meet two criteria. Readily be convertible to known amounts of cash. So we should know like what's its value and they're readily convertible to that amount. The original maturity is 3 months or less. And what are the examples to this one? So if the company has a treasury bills, matures in 3 months or less, there's any commercial paper or money market funds, they are considered cash equivalents. Okay, so here's an exam trap and they like to ask this one. Let's say they give you an example. There's a 6 months T-bill, purchase 2 months before maturity. Remember the 3 months rule? They bought 2 months before, so we are in month 3. They still have 4 months until it matures. This is not considered cash equivalent. Now let's talk about restricted cash. The most common example you can think of, maybe like an escrow or some bond sinking funds. So the company has the cash, but they are restricted for some purposes. There's a recent update. The restricted cash must be included in the beginning and in cash balance of the statement of cash flows. Let's give the beginning cash balance is 120. Then they had a 30,000 increase in cash during the year. Restricted cash for bond sinking funds for $20,000. We include this in the beginning balance. In this example, the ending total cash would be $150,000. You may ask, why are we doing this change? The logic is, even though it's restricted, it is still company's control. If you want to have a comprehensive view of company's operations, know that information. Think about your friends, maybe both don't have cash or maybe both have $10,000 cash, but you have $1 million in an escrow account that you're buying a house. In financials, you are not the same. If people were investing, they would want to know those things. We are moving from cash to non-cash. Some activities are substantial, but cash is not involved. Examples could be bonds payable, converting common stock. There's an activity, but no cash is involved. Or maybe they acquire equipment by issuing a note payable. They issued a note payable, and then they acquired any equipment the same way, asset for liability. Or the company had a land and they exchanged that land for a building, basically an asset exchange. So whenever this kind of activities happen, they do not appear in the cash flow statements. They are disclosed in a supplemental schedule or footnotes. If cash is not involved, they are in the supplemental or footnotes. It's also an exam trap. So these transactions involve only long-term assets, liabilities and equity, no current items. And items like stock dividends, stock splits, retained earnings appropriations, and cash flow per share are not in the statement because they are for accounting reclassifications or appropriate disclosures. Okay, let's talk about two methods. There are two ways to present the information. One is the indirect method. The other one is the direct method. In the end, they give us the same number. It is just a preference, like the explaining it's the one way or another. 95% of the companies use the indirect method. And in the exam, you are going to see questions mostly related to indirect methods. How does it work? So basically in the indirect methods, we start with the net income. Then we make some adjustment for non-cash items. And then in the end, we reach the number. For the direct method, we basically start with the actual cash receipts and payments. We got cash from customers, and then how we reach the number. The direct method is much more detailed, and FASB prefers this, but it's not always logical to use this one, so mostly we are going to see the indirect method. We get a lot of information about cash flow statements. They make sense logically, but then I think for a lot of us, first time when we are doing the questions, it's more confusing in the exam. They usually give a comparative balance sheet. From the balance sheet, look for the equity, if there's any changes, and if there's any changes in the account balances, so you can see what you are looking for. Then the second thing, look for the income statement data. Look things like a net income, any depreciation, if there's any gains and losses. Also look for any additional information, if they had any asset sales, if they any issued debts, or if there's any dividends. Those are the things you need to pay attention. Like the one good exam strategy, start by balance sheet, additional information, and try to explain why things change. Then you can understand where the cash is going. Okay, now let's do a couple practice questions. So we have a corporation and they said they engaged the following transactions. Here is the information, and they said they're asking us the financing activities, how much net cash was provided or used by financing activities, operations. The company purchased equipment for $80,000 cash. That is related to investing activity, not financing. They issued common stock for $50,000 cash. This one is financing activities. They paid $15,000 cash dividends related to financing activities. Received $5,000 interest on investments. Seems like the trap. Interest is related to operations. Sold land for $30,000 cash related to investing activities. The answer should be $35,000. The correct answer is $35,000. Let's go over again how the calculation is done. Financing calculation, financing activities. The activities, they are funding the operations, paying the investors. They issued common stock for $50,000, paid cash dividends for $15,000, so net cash provided is $35,000 from financing activities. Why the other ones are excluded? They purchased $80,000 equipment related to investing because it's a long-term asset. They sold land for $30,000, also related to investing because it's a long-term asset. Interest received $5,000 is an income statement item, therefore it is operating. We have another practice question related to restricted cash reporting. Restricted cash is now reported on the beginning balance. The question is saying that at the beginning of the year, Silverstream reported the following balances. They have cash in the checking accounts for $200,000. They have some treasury bills, $25,000. And they have some restricted cash in the bond sinking fund for $50,000. They're asking us the beginning cash balance. The beginning cash balance is cash plus restricted cash. I don't even know why I'm writing it. Cash plus restricted cash. So what is it going to be? $200,000 plus restricted cash. Even though it's restricted, it's still company money. $50,000. So the answer is 250. Before the change, the answer could have been 200,000, but no longer it is the case. And here we can see the solutions also here. That's the ASU 2016-18. And I'm saying new, but when I was studying this, it was new. The statement cash flow explains the change in the total of cash equivalents of the plus restricted cash. Our calculation is cash plus restricted cash 150. Okay, takeaways from today's class. The first one is the classification. We have three different types of classification: operating, investing, and financing. If it's income statement, operating. If it's assets, strategic, planning, investing. Debt and equity, it's financing. If there's a restricted cash, be included in the beginning and in cash balances for reconciliation purposes. For the CPA exam purposes, when they say cash equivalents, or if they're asking that, we need to think that the original maturity 3 months or less from the date of purchase. The non-cash activities, we want to disclose the footnotes. They are not included in cash flow statement. If it's not cash, it is not here. Now we finished the first portion of it. Now let's move to the next section, the operating activities. We're going to go more details, the indirect methods and the working capital. Thank you.